Hello and welcome back to part 4 of this drafting and interpreting financial statement mock exam walkthrough. Hopefully you found the first 3 parts useful. This is our last part, so we'll be running through tasks 6 and 7. And remember, if you have found this series useful, to hit that like button and subscribe to the channel for more AAT content. Alright, let's swap over to the last 2 tasks and make a start. Right then, so task 6 is worth 8 marks and is about interpreting financial statements using ratio analysis. You've been given the financial statements of Champion Limited for the year ended the 31st of December 20x1. You are now required to prepare financial ratios to assist your manager in her analysis of the company. So we can see that we've been given a statement of financial position on the left and a statement of profit or loss on the right. So we'll be using these to calculate the ratios. So let's scroll down and have a look what ratios we need to calculate. So it says calculate the following ratios to 1 decimal place. Very important. So they all need to be to 1 decimal place. And we've got 4 to calculate. So we've got asset turnover using net assets. We've got gearing, operating profit margin, and trade payables payment period in days. Now, there's no excuse on these. I know there's a lot to learn, but there is one that once you've learnt them, you should be absolutely fine. We should be getting full marks on this task. Okay, so let's hop into your asset turnover first, and this is based upon net assets. So the formula to calculate this will be your revenue over total assets minus current liabilities. So it shows how well the business is generating revenue from the net assets of the business. It's somewhat in the name of the ratio. So let's have a look at our figures for this then. We start off with revenue, which is our 56,451,000, and that will be divided by your assets figure less current liabilities. So 88,746,000 less your current liabilities of 5,620,000. So if we calculate that, that gives us a asset turnover of 0.7 times. Remember, we do need to round these figures. So on this one, obviously round up because of the decimal that it gives you. So to 1 decimal place would be 0.7 times. The next one is gearing then. So gearing is calculated as debt over debt plus equity. And for the purposes of this exam, your debt figure will be just referring to your non-current liabilities, so we can ignore our current liabilities. So therefore, to calculate this one, it would be your debt of 43,850,000 over your debt plus equity. So again, 43,850,000 plus 39,276,000. And if we do that, that gives us a gearing ratio of 52.7%. Now, I believe in the answers on this one, it's 52.8. I do think that's a calculation error. Either that or I've got 3 dodgy calculators, because when I calculate this and put it to 1 decimal, it does come out at 52.7%. So I do believe that's probably just a typo in the answer sheet. Moving down to profit margin. So operating profit margin is quite simply your operating profit over your revenue figure times 100. So it would be 14,603,000 over 56,451,000 times 100, and then rounded to 1 decimal place, which gives you an operating profit margin of 25.9%. And then the last one, trade payable payment days, simply shows how quick the business has paid off its credit suppliers on average throughout the year. And to calculate that, it would be our trade payables of 3,589,000 over our cost of sales figure of 31,759,000 multiplied by 365 to give you the answer in days, which works out again rounded to 1 decimal place to be 41.2 days. Okay, so nothing complex on those. Those are ones where you should be able to walk through them with no real issues as long as you know your formulas. So we can now move on to task 7, which is our last task, and it is a written task. It's actually our biggest written task, although for me, I do think it's probably the easiest out of the 3 written questions. And we would hope that you would pick up the majority of marks on this as long as you follow the format that I will give you as we walk through the question. So it is worth 22 marks and is about interpreting financial statements using ratio analysis. So the chances are you'll be given a number of ratios and then you'll have to perform some form of analysis on them. So let's have a look at the scenario. Luke Berry is a shareholder of Walmington Limited. Walmington Limited? Let's go with that. He has heard rumours that the company is experiencing financial difficulties and has asked you to analyse Walmington Limited's most recent financial statements to help him decide whether to keep or sell his shares. His primary concern is profitability. You have calculated the following 4 ratios based upon Walmington Limited's financial statements for the last 2 years. So we can see we've got operating profit margin, the quick ratio, also known as the acid test. We've got their gearing and we've got their inventory turnover. So we've got 20x1 on the left and 20x0 on the right. So obviously 20x1 is the most recent year, 20x0 would be a year behind. So this is the information, and it's also available in the references section to the right. However, I don't think there'll be too much scrolling, so we should be okay. So the first part then, we need to identify whether the ratios for 20x1 are better or worse as compared to 20x0. And then after that, explain what this comparison may tell you about the company. Now bear in mind, we don't have loads of information here, so there is going to be some, when I say guesswork, I mean we'll be suggesting possible reasons for those changes. Okay, so let's have a look then. So operating profit margin first, and we need to determine whether it is better or worse. So the higher the percentage for operating profit margin, the better. So in this scenario, it's gone from 9.2% up to 12.6%. So therefore it is better because it has increased. The business is generating more operating profit as a percentage of its revenue. Okay, so following this, we need to explain what this comparison may tell you about the company. So step 1, explain what that actually means. So explain what the ratio is telling us. So it's actually what I've literally just said. So therefore, the business has increased its operating profit margin, which shows it is producing a higher operating profit in comparison or from its revenue or sales. Okay, that is how I would start all of these, by explaining exactly what the ratio is telling us. So in this scenario, as I said, the higher the operating profit margin, that is showing that the business is generating more operating profit in comparison to its sales. So we now need to explain why or how that could have happened. Now, in order to be able to do that, all you need to do is think about what actually goes into calculating the ratio, and that could tell us how those changes have come about. So let's think about what goes into this. So operating profit, obviously, but that is made up of a number of different figures: the revenue, cost of sales, and expenses. So if this has gone up, there's a few different things that could have happened. So we could have had increased revenue. We could have had a decreased cost of sales. Now, if we had gross profit margin, we'd be able to know that. However, we've not been given that. We've only been given operating profit margin. So we don't know whether it's a decrease in cost of sales, or it could even be a decrease in our expenses, but our revenue has stayed the same or gone up. Any number of these factors would cause our operating profit margin to increase. So let's get that in there. So let's put some possible reasons in. The most obvious first is that our revenue has increased. But not only would our revenue have increased, that would more than likely be because we've increased our selling prices. Remember, this is a ratio, so it's not just about increasing revenue and increasing costs along with it. It's widening the gap. So we're saying that either expenditure has stayed the same and revenue has increased, or revenue has stayed the same and cost of sales or expenses have decreased. So this shows that the business may have increased its selling prices while keeping cost of sales the same or lower, or reducing its expenses. If expenses were to reduce and revenue were to stay the same, then this would also increase the operating profit margin. So it's all about widening the gap. Okay, so like I said before, it doesn't mean that the revenue has definitely increased. If you were to keep your revenue the same but lower your costs, obviously that's also going to increase your operating profit margin. Now, the last thing I would do is try and link it to any of the other ratios. Now, we haven't actually been through any of the other ratios yet, so that can be quite tricky. Initially, it may be that you either want to leave this until the end and then come back and add in any comparisons, or you can look through them all initially and try and make any comparisons up front. In terms of what comparisons we can make here, let's think about any of these other ratios that could be affected by this. So the quick ratio wouldn't be affected. Obviously, we know that that is current assets and current liabilities, less inventory, so we can ignore that one. Gearing, it's debt over debt plus equity, so again, wouldn't really be affected by our revenue or operating profit. Now, inventory turnover would be affected because if we think about the inventory turnover formula, it does involve inventory figures and cost of sales. Now, this has decreased, which is interesting because if we were saying that selling prices may have increased, it may take longer for us to move our stock. So that actually would link the two together in that sense. Now, we obviously don't know, we can't say 100%, but we can certainly suggest that there is a link between the two. So with inventory turnover decreasing, this may also suggest that the business has increased its selling prices. So obviously that would have a positive effect on profit margin, but it may mean that you're slower to move stock because less people are buying. So increased margins, but slower movement, less volume, which can work really well for some businesses, but the two would tie together. So that covers the comments for our operating profit margin. So we've explained what the ratio shows, we've given some possible reasons as to why that may have happened, and then we've linked it to another ratio. Now, it may not always be possible to link the ratios. However, where you can, it is a good idea to pick up an extra mark. So we can now move down. And our next one is our quick ratio or acid test ratio. So first we need to determine whether it's better or worse. So it's gone from 1.3/1 to 0.8/1. And therefore, it's got worse. Okay, the higher this is, the better it is. We're actually showing that we can now not cover our current liabilities because it's dropped below 1 if we take out our inventory figure from the ratio. So it's got worse. Okay, so again, we want to keep with the same approach as we did with operating profit margin and first explain the ratio. The quick ratio, or acid test, whichever you want to go with, it's the same thing, shows how many times a business can pay its current liabilities with its current assets less inventory. This is because inventory can sometimes be slow to sell in order to generate the cash needed to pay off the business's liabilities. So it's similar to the current ratio, it just takes out your inventory valuation, and that is because inventory can obviously take time to sell. So it's a variation of the formula, and anything below 1 can be seen as risky. So I would be saying that because now it's dropped below 1. We're now at 0.8 over 1. So that's higher risk for the business. So the business is unable to cover its current liabilities, i.e. short-term debt, with its current assets if it were to remove inventory. So the next bit, remember, we need to suggest why that might be. So that could be due to a number of factors. That could be that inventory is quite a high figure. So most of our liquid cash is tied up within inventory. It could be that we've got less money in the cash or bank reserves. It could be that our trade receivables are lower than what they used to be. It could mean that trade payables have increased. So there's a number of different reasons. All we need to do, put 1 or 2 down. So I would say either this could be due, just get 2 down and then you'll cover your marks, to either increased trade payables or decreased trade receivables. It could also be down to a decreased bank or cash amount. Okay, so we've explained what the ratio is, we've said the position of the business, and we've explained 2 reasons why that could have been. So let's now have a look. Can we link it to any other ratios? So within this, let's think about what we've got. So we'd have such as trade receivables, we'd have cash, bank, prepayments, we'd then have trade payables on the other side, or accruals. So is that going to link to operating profit margin? No, it's not. Is it going to relate to gearing? Possibly, because if we've paid off some of our loans, then that would, yes, decrease our non-current liabilities, but it would also decrease our cash balance. Now, this has gone down. Our gearing has reduced, meaning that our non-current liabilities, in theory, are or could be lower. It could also be down to an increase in share capital, so we don't know for definite. However, there is that potential link there. So what we could say is the decrease in the gearing ratio may suggest that the business has paid off some of its loans, and therefore this would reduce the bank balance, which would be consistent with the decreased quick ratio. Okay, so we've explained the ratio, we've said what might have caused it, and we've given a link to one of the other ratios. Fantastic. Let's move down to gearing then. So first, again, we need to determine whether it is better or worse. So let's scroll up. So we can see it's gone from 54.1 to 40.3, which is better. So the lower the gearing, the better, because it's seen as less risk for the organisation. So it's got better. So let's explain it. So the gearing of a business shows its debt in comparison to its debt and equity combined. The higher this is, the more risk to the business. As the business has reduced its gearing, this is showing the business has reduced its risk. So this could be down to a number of reasons. So they've either reduced their non-current liabilities or they have increased their share capital or retained earnings. So all we need to show is this new paragraph. This could be due to reducing non-current liabilities such as loans, or be due to increasing its equity by raising more share capital or increased retained earnings. So let's now link it back to our previous ratio, the quick ratio. Obviously, we don't need to explain it because we've already explained it, but we can put a brief note in there. So I would say something on the lines of, as above, a reduction to non-current liabilities such as paying off loans shows consistency with the reduced quick ratio. This could result in lower interest charges in the future due to decreased loans. Okay, so we've explained what the gearing is, explained what the formula shows. We've said that it's decreased, which is good for the business because it's showing they have reduced its risk. We've said why that could be, and we've done a link, as we did before, to our previous ratio. Okay, so then the last one we have is inventory turnover. So I think we had a look briefly at inventory turnover before. So it's gone from 10.6 down to 7.9. So it has reduced, it is worse. So the quicker we can turn over our inventory, the better. It means we are not storing it for as long, which is associated with costing the business more. So the quicker we can get that through the system, the better. So it's got worse because it's got lower. So first, explain, what does it mean? So the inventory turnover of a business shows how quick it takes to sell inventory as the business has a reduced inventory turnover. It shows they are holding on to inventory for longer. This may be due. Remember, moving straight into the reasons why this could have been. So this may be due to increased selling prices, as we said earlier, which would be consistent with the increased operating profit margin. It could also be due to over ordering of stock, which would be consistent with the decreased quick ratio. Because if we think about it, the quick ratio has gone down. And we said earlier, this could have been due to having a lot of our money tied up within stock. So that would make perfect sense that our inventory turnover has decreased if we have over-ordered stock. So the two, again, do tie together. So let's just explain that. So I would just add to that, this could also be due to poor inventory inventory management. Okay, so we've explained what the ratio is. We've said this may be due to increased selling prices, which would be consistent with the increased operating profit margin. And we've said that it could also be due to over-ordering of stock, which would be consistent with the decreased quick ratio. So both of these are reasons why, and we've managed to tie them back within the same point to two of the other ratios. So I don't think there's anything more to add to that because we've managed to actually integrate our points more succinctly in this particular example. Okay, brilliant. So let's move down. So 2 more to go. So part B, recommend whether Luke should keep or sell his shares based upon his primary concern of profitability. Well, considering the operating profit margin has gone up, I would be suggesting to Luke that he keeps his shares. It's had a good increase on operating profit and there's no major concerns from the other ratios, so I would recommend that he keeps those shares. So I would recommend that Luke keeps his shares due to the operating profit margin having increased. Absolutely fine, it's only worth 1 mark, nothing more we need to add to that. And then the last question, specify one other profitability ratio you could calculate to help Luke make his decision. So there's a few that you could go for here. The main ones being gross profit margin is probably the most obvious, although return on capital employed is also a really, really useful one because that makes the size of the business irrelevant. It's a great leveler. So any of those will be absolutely fine. We'll play it safe. We don't need to explain this much either because it literally says specify one other ratio. So nice and easy. So I would also suggest using the gross profit margin ratio. And that's it. Okay, so that finishes task 7 and this mock exam walkthrough. And that finishes off this mock exam walkthrough. Remember, if you have found this video useful, to hit that like button and subscribe to the channel. And if you do have any questions as well, do drop them in the comments below. Thanks again for watching. I'll see you in the next one.